Welcome to the wild ride of Archegos Capital Management, the financial saga that left Wall Street reeling. Buckle up as we delve into the investment strategies that skyrocketed their fortunes, the disastrous collapse that followed, and the colossal losses that sent ripples through the financial world. Bill Huang, the brains behind Archegos, was the finance world's Houdini. Huang was a shrewd investor with a knack for turning modest investments into multi-billion-dollar portfolios. After a scandalous exit from Tiger Asia, he launched Archegos as a family office, keeping his high-stakes moves out of the public eye. His secret weapon? Total return swaps. Archegos wielded this secret weapon by making deals with banks, offering them hefty fees for economic exposure to specific stocks. If the banks were unable to find a counterparty for Archegos, they would assume the role themselves. This involved selling the economic benefits while purchasing substantial quantities of the stocks to hedge their risk, effectively placing significant bets on Huang's behalf. Imagine making colossal bets on stocks without actually owning them. That's the electrifying magic of total return swaps. These financial derivatives allowed Archegos to amass enormous positions without triggering pesky disclosure requirements. It was like playing Monopoly with real money, and Archegos was on a winning streak. But Huang wasn't one to spread his bets thin. Archegos focused heavily on a few key stocks, with Viacom CBS and GSX Techedu leading the charge. By concentrating his investments, Huang was able to manipulate stock prices, thereby inflating the value of his portfolio and enabling him to borrow even more. This high-risk, high-reward strategy paid off, until it didn't. GSX Techedu, a Chinese education company, became the epicenter of Archegos' strategy. As short sellers targeted GSX, alleging fraud, Huang's aggressive buying created a short squeeze, driving the stock price higher and leading to substantial losses for short sellers. It was a financial tug-of-war with Archegos winning temporarily. Archegos owned more than half of all freely traded shares of Viacom CBS, with a $10 billion stake. But the house of cards began to wobble when Viacom CBS announced a stock offering. The share price nosedived, triggering margin calls that Archegos couldn't cover. Despite frantic efforts to prop up stock prices, the firm's positions unraveled faster than a cheap sweater in a hurricane. With Archegos unable to meet its obligations, banks were forced to liquidate massive stock positions. The market was flooded with large blocks of shares, causing prices to nosedive. More than $100 billion in market value evaporated in days. Credit Suisse took a $5.5 billion hit, Nomura lost $2.9 billion, and other major players like Morgan Stanley and UBS also suffered heavy losses. The true extent of the disaster was only revealed after the chaos when the dust settled. Archegos used total return swaps to build large concentrated positions across multiple banks without having to disclose them, which meant each bank was unaware of the overall risk. It wasn't until the very end that banks discovered Archegos was buying the same stocks at all of its banks. In the aftermath, Bill Huang and his CFO Patrick Halligan faced charges of fraud, market manipulation, and racketeering conspiracy. The trial revealed a web of deceit, with Huang falsely claiming substantial liquidity while operating on financial fumes. Convicted on multiple counts, Huang now faces the potential of spending the rest of his life behind bars. The Archegos debacle is a cautionary tale of unchecked leverage, the dangers of concentrated bets, and the perils of operating in the shadows. It's a stark reminder of the volatility and risk inherent in the financial markets. The saga underscores the need for greater transparency and regulation to prevent such meltdowns in the future. So next time you think about making a high-stakes bet, remember the story of Archegos, the gamble that shook Wall Street to its core.